Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Monday. It is November the 14th. A few days ago, I made a video and covered a couple of small cap stocks from Canada. And not a lot of people watched the video, which is fine. But quite a number of people gave me homework to do on Canadian small caps. Now, the Canadian market is not one that I pay a lot of attention to, but at the same time, I have some major positions in Canadian stocks, not only energy stocks like Enbridge and Pembina, but also financial institutions like TD, which is Toronto Dominion Bank, and Bank of Nova Scotia. I also have some uranium stocks in Canada like Cameco. So it's not like I'm oblivious or not paying attention to Canadian energy, but because I live in the US, I've never really paid distinct attention to Canada specifically, and probably not nearly as much as what I should. So what I decided to do was take a few minutes and just kind of see what's going on in Canada, take a look at some of the major stocks that I'm going to cover in this video, which is four of them. I'll come back to that in a minute. It's either 5 or 4, depending on where you're coming from. And then I'm going to tell you what the people on the channel gave me to do as homework at the end, which is what I'm going to do sort of as a follow-up to this particular video. So what's in the news? What's going on in Canada? Oh, Canada. Oh, Canada is actually the national anthem of Canada. Well, I'm not sure the anthem is called Oh Canada, but it starts with Oh Canada. Canada's benchmark heavy crude Western Canadian Select, Western Canada Select, WCS, is trading at a steep discount to WTI after weakening sharply last month, and is expected to remain subdued well into next year. So there's your first pointer. Western Canada Select, the type of oil that Canada produces mostly, is expected to remain subdued well into next year. What that means for contrarian investors is that this is potentially a buying opportunity, but we'll get more into that over the next few days or so as I go through my homework that you so very kindly allocated to me. Why is WCS under pressure? The Hardisty Alberta hub is trading close to $30 a barrel under WTI's price. So when WTI is trading at around sort of high 80s, maybe almost close to $90, then that means Western Canada Select is trading at around 60-ish per barrel, close to 30 a barrel under WTI, having averaged $16.67 a barrel below WTI for the first 3 quarters of 2022. So point number 2, Canada has been under pressure from an energy point of view for most of 2022. So who is to blame? Well, as a general rule, whenever somebody asks me who is to blame, I always begin with the politicians, because for most of the time, despite their best intentions, they just continuously manage to screw up royally. So who's to blame this time? So, well, Biden, well, maybe not the person, but the administration, has been releasing millions of barrels of oil from the US Strategic Petroleum Reserve, which is no longer strategic nor petroleum reserve, because strategic can't be strategic if it's empty, and it's near empty, and petroleum reserve, it can't be a reserve when it's kind of empty. He said he was doing this to combat high oil prices. There's a possibility that he might have been doing it to try and win a few election votes in the recent midterm elections. And who knows, from that point of view, he might have actually achieved a limited amount of success by draining the Strategic Petroleum Reserve. Millions of barrels of predominantly sour crude has left the US Gulf Coast, which is home to the world's largest heavy oil refining center, awash in crude of similar quality to WCS. In September, BP Husky's Toledo, Ohio refinery, which processes up to 90,000 barrels per day of heavy crude, shut down following a fatal fire. The Canadian oil market was slow to react, and as other US refineries went into scheduled turnarounds, cutting demand further, WCS, WTI differentials collapsed. Competition from cheap Russian crude on the global market and high natural gas prices made refining heavy oil more expensive. Why is there cheap Russian crude on the global market? Well, Russia is selling its cheap Russian crude to countries that potentially could have purchased Canadian crude, which includes countries like China and India. In addition to that, Russia is selling cheap Russian crude to Saudi Arabia, who in turn sells its highly priced Saudi Arabian crude to Western countries, including the United States. And then at the bottom here, output in Alberta, Canada's largest crude producing province, hit a record high just in September. So when you are producing too much, when you're already facing limited supply, that supply-demand curve is not in your favor, and you are going to put pressure on the price. WCS hit a record discount of more than $50 a barrel in a previous blowout, and that was in October 2018, and not too long ago. However, unlike before the recent deep discount, the current deep discount is led by weak downstream demand rather than pipeline bottlenecks. ENB in the middle of the screen there, ticker symbol ENB, is Enbridge Energy. It's one of my longs in Canada, so I've been feeling the pain from having an underperforming long. But to be fair, this is one of my foundational stocks, and I'll come back to that one in just a second to explain why it is still in my portfolio. Canada's export capacity has been broadly in line with production. Pure play heavy oil producers without refining capacity are most impacted by weak WCS prices. And these include two, which I'm going to talk about briefly in just a minute: MEG Energy, MEG, and Athabasca Oil, according to RBC. RBC is Royal Bank of Canada Capital Markets. What now? Well, several industry analysts and company CEOs, including Cenovus Energy. So about a year ago, a lot of people on our channel was talking about Cenovus Energy and said buy, 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 buy. And they were mostly correct. We're going to talk a little bit more about that in just a second too. So says CVE CEO Alex Pourbaix, I'm not too sure how to say that name, and they expect the deep WCS discount to persist throughout the first half of 2023. So your potential buying period might be over the next few months into the first half of 2023. The United States Strategic Petroleum Reserve releases are due to wind up at year-end, but upheaval in the global crude market due to Russia's invasion of Ukraine is clouding the outlook for WCS. Now, just as a matter of opinion there, it's more Russia's selling cheap oil into the market, as I just explained a minute ago, rather than Russia's invasion of the Ukraine. Whilst I'm not saying this doesn't matter, because at the end of the day, you can say that that is the genesis of the situation that we find ourselves in, Russia invading the Ukraine. The fact of the matter is, as long as Russia keeps selling cheap oil into the marketplace, there is going to be some pressure on WCS. I can't say it's very bullish for as long as Russia is still Russia, one broker said. Well, one broker said, I don't know who that broker is. So let's talk about these 5 companies. And that's why I said at the beginning 5 or maybe 4, depending on how you look at it. So the reason why it's five to start with is because it included Husky. But Husky Energy was acquired by Cenovus, or they merged in 2021. So now I'm down to 4 on this particular video in terms of the stocks that I mentioned. So Athabasca, Cenovus, Enbridge, and MEG, or MEG Energy. The Canadian people can tell me whether it's okay or appropriate to say MEG as opposed to MEG, because I don't know. And by the way, I'll give you an apology for another I don't know in just a minute. Looking at these companies here, you can sort of see the different exchanges that they trade on. So I, as a US resident, can buy Cenovus and Enbridge on the New York Stock Exchange, but I need to buy MEG and Athabasca either on the Toronto Stock Exchange, which I can do because I have Canadian investment accounts as well, or otherwise I can buy it OTC. You can see at the bottom of the screen here, they are similar, but yet different. And of course, 2 of them, MEG and Athabasca, are uniquely Canadian, specifically focused on Canadian oil and gas, energy and production. For the technical guys here, we can look at this 20-day raw stochastic. So you've heard about this from me on several occasions when I spoke about it in previous videos. If the 20-day raw stochastic, just as a general rule or guideline, is over 80, then this particular stock is overbought. So based on the 20-day raw stochastic, now might not be a good time to get into Cenovus Energy. The others are kind of all sort of the same, around 60 something. So they're kind of in the middle of the pack. If the 20-day raw stochastic is below 20, then it's usually potentially a good buy. But you need to do your due diligence and still make sure you're making the right decision that matches your investment thesis. At the bottom, you can see the changing sentiment from the analysts. So right at the bottom there, you can see the last month's opinion, mostly sell, 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 sell on this bottom line here. And then just above that, you can see the sentiment has now changed quite significantly. So on Cenovus, a month ago, it was 64% sell. Now it's 88% buy. Even Enbridge, which was 100% sell a month ago, is now just 56% sell. And then the other two are buys as well, even though they were sells just 2 months ago or a month ago. Taking a look here at the performance of late, it's not too bad sort of when measured against the entire market as a benchmark, but when measured against the energy sector specifically, there's some underperformance here of late, in other words, most recently, but overall it's been pretty good. And I'll show you a chart in just a second on the next screen, but positive returns over the last 6 months or so. As you know, I'm a long investor. I don't day trade. And the disappointing one here in the middle is Enbridge, which over the last 6 months has delivered negative 8.29%. If we look at the annual sales and compare that to the market cap, it always gives me an interesting picture to look at. And you can see that Cenovus is a company that does almost $37 billion in sales, and it has a market cap of only, comparatively, $41 billion, whereas Enbridge has a market cap of 84, but it does 37 billion in sales. This is a great company, by the way, but there's quite a delta between the annual sales and the market cap. But look how close they get here on these small caps. So MEG is doing 4.4 billion in sales. It only has a market cap of 6.2. And how about Athabasca? Over $1 billion in sales and just $1.6 billion in market cap. Those things indicate to me that some of these companies are significantly undervalued, and Athabasca particularly looks good here. In addition to that, right at the bottom, Athabasca also has the lowest price earnings ratio at only 3.3, whereas MEG and Cenovus are both sort of screaming buys, not as good as Athabasca based on PE, but certainly very attractively priced, and Enbridge a little bit too expensive, right? Remember, we want to be at 15 or below, because 15 is sort of the benchmark average for the S&P 500. Look at the chart here. If you were invested in Athabasca over the last year, so in other words, this year to date from January to now, you have done really, really well. Congratulations, and best of success going forward as well. But look at the returns here. Athabasca gave you, well, you more than doubled your money. And on Cenovus and MEG, you did really, really well. And Enbridge, being the laggard here, only close to 3% in terms of its year-to-date return. You can say, Mr. Roxy, why is this still in your portfolio? Well, I also keep it because it pays a dividend of about 6.5%, and 6.5 plus 3 is about 10%. If I can do 10% per year, it's dragging my portfolio down because I'm trying to achieve 15. But at the same time, from here on up, I think Enbridge will be probably trending more up than down. So I expect better days ahead for Enbridge as well. I might trim a little bit of Enbridge and drop some of the cash into Athabasca, which looks like, as I said, a screaming buy right now. Let's take a quick look at the 4 stocks here. You can buy Cenovus for about $20. It's a $40 billion company. Attractive PE ratio of, currently, this is as of today, November 14th, 410, so after market close. PE ratio 11, it's attractively priced at that PE ratio. It's not too far off its 52-week high, $25, currently 21, but it's outperformed the indices, and I'm comparing it here to the Dow Jones and the S&P 500 handsomely, like most energy stocks have. What about Enbridge? So Enbridge has been a laggard, but it's still comfortably outperformed the indices. And remember, the Dow and the S&P 500 and the NASDAQ all down year to date, yet Enbridge is kind of sitting there sort of just above zero. An $81 billion company, so it's not a small company by any means. It's actually borderline super major. PE ratio a little bit rich, 20, too high right now. It's sitting just left of center on its 52-week range. I think Enbridge is more likely to go to 45 than what it is to go to 30 for example, right now. So I'll hold it for a bit and see. But as I said a minute ago, I might trim a little bit and park some money in one of the faster growing small caps. How about MEG? It's a $15 stock. It's a $4.5 billion company, very attractively priced in terms of its price earnings ratio of less than 7. It's kind of sitting in the middle of its 52-week low and high. So who knows if it's trending up, it's going back up towards 20, that's possible. And of course, it just crushed the indices if I compare it to the Dow Jones and the S&P 500. More sort of along average lines when you compare it to the energy sector as a whole, outperforms still, but not as incredibly good looking when comparing it to the Dow Jones or the S&P 500. How about this little guy, right? So Athabasca, you can buy this. I mean, you can pick up, I don't know, depending on how much cash you have lying around, you can pick up a few hundred, maybe even a few thousand shares at $2 a share. It's a $1.2 billion company. So even though it's a small cap, it's not that small. The PE ratio is a screaming buy at 3.7. I haven't done a deep dive on Athabasca yet, so I'm not sure if all these things that look right for the wrong reasons, or whether they look right for the right reasons. So I don't know, but what I do know is $2 for this particular stock seems to be, as I said, a screaming buy. It's sitting just right off center on its 52-week range. If it goes back up to around $3 or so, you probably have a nice return in addition to the returns you've already banked if you were long in Athabasca for 2022 year to date. The performance compared to the Dow Jones and the S&P 500, it's not even comparable. I mean, it's no contest, right? If you were long in Athabasca, congratulations, well done. Man, you made a good trade here, you did a good thing. So how about we go to our YouTube channel just for a second. So the first thing I need to do is just apologize to Canadians. Tony mentioned to me that Canadians referred to the Alberta oil sands rather than tar sands. I think I slipped up and said tar sands in my previous video. I didn't mean to be disparaging, and I certainly didn't mean any harm. Maybe it's a combination of being old and being a slip of the tongue. But thanks, Tony, for reminding me that it's the oil sands. Maybe in the future, I won't even talk about that. I'll just talk about Alberta, a place I've visited many, many times. What a wonderful province in Canada Alberta is. Areas said, take a look at SU, which is Suncor, and MEG. Well, I just talked about MEG in this video. Anonymous gave me homework to do. He said, have a look at Obsidian Energy. I hope I'm saying that correctly. He also mentioned Yangara Resources, Vermilion Energy. With Vermilion, I covered probably about a year or so ago. Thor said, look at, man, forgive me for my pronunciation here if I screw this up, but he said, look at Periode, maybe, I don't know, Prairie Provident, and Petro Tau. Tony also said, take a look at Whitecap. I think I talked about Whitecap in the previous video, and Pine Cliff Energy. So I have kind of 10 green arrows here of stocks that I need to study. And what I'm doing is I'm looking for a really inexpensive good buy for us. Athabasca might be one, but I need to look at some of these others as well. I know Suncor, but I don't know any of these smaller companies really well. I know Vermilion a little bit as well. But yeah, you know what? If you guys know them better than me, let me know what you think and tell me what they're all about. So that's sort of my wrap of Canada and introduction to Canadian energy. So 4 stocks I shared with you in this particular video. They may be buys, they may be not. Canada is one of the most beautiful countries on the planet. If you've never visited, you should probably pencil it in your to-do list or your bucket list of things that you want to do sometime in the future. But for now, focusing on energy, I talked about 4 stocks here. I have 10 relatively small caps, and I say relatively small caps because companies like Suncor and Vermilion Energy are not necessarily small caps. They're larger, but some of the others are really tiny. It might be a good time to get in with the pressure on Canadian crude in terms of pricing right now. Many of these companies are trading at a discount. So if I can find something that I feel maybe it might not be the next Occidental Petroleum, but it could be good. So if I find something that is worthwhile sharing with you, I will do so. And until then, thanks for watching. I will talk to you soon. Bye-bye.